Hello and welcome to the channel, where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze opportunities. Today, we're shining a spotlight on a very specific microcap stock that has recently caught our attention, BOXL Corporation, ticker symbol BOXL. We'll break down why this stock is generating buzz in the hard-to-borrow community and what it could mean for traders. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with BOXL Corporation, BOXL. This company operates in the technology and consumer electronics sector, designing, producing, and distributing interactive technology solutions. Think interactive flat panel displays and related solutions for education, health, corporate, military, and government sectors globally. It's a microcap name with a market capitalization of just $3.05 million and an estimated float of only 0.5 million shares. Now, let's look at recent price action. BOXL has seen a challenging day, down 31.18% today. Over the last 5 days, it's down 23.38%, but looking back 30 days, the stock is actually up 14.0%. Volume-wise, today saw 229,000 shares traded, significantly below its 30-day average volume of 2,836,660 shares, giving it a relative volume of just 0.1x. Dot chart, BOXL daily price and volume. What is cost to borrow and why it matters? At the heart of any short squeeze discussion is the cost to borrow, or CTB. This is the annualized fee that short sellers must pay to borrow shares of a stock before they can sell them. When a stock is in high demand to be shorted, or if there's a very limited supply of shares available to borrow, this fee can skyrocket. A high cost to borrow indicates increased risk and expense for short sellers, making their position more precarious, especially if the stock price starts to move against them. It's a key indicator we track. Why the stock is hard to borrow right now. Now, why is BOXL on our radar? Because it's currently extremely hard to borrow. Our data shows an annualized cost to borrow fee for BOXL an astonishing 944.0%. That's nearly 10 times the principal amount just to hold a short position for a year. With an estimated float of only 0.5 million shares, the supply of available shares to borrow is severely constrained, although the exact number of shares currently available to borrow is unknown. This combination of a tiny float and astronomical borrow fees is what flags BOXL on our hard-to-borrow screener. Our internal composite squeeze score for BOXL sits at 40.8 out of 100, which reflects its elevated CTB and small float, even with today's price weakness. Squeeze mechanics explained. So, what does it mean when a stock is hard to borrow? It means short sellers are either desperate to initiate new short positions or they are already heavily short and the available shares are scarce. If the stock price begins to rise, short sellers, facing these incredibly high borrow fees and potential margin calls, may be forced to buy back shares to close their positions. This forced buying creates a chain reaction, pushing the price even higher and trapping more shorts. That's a short squeeze. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to stay short. Dilution risk check. When evaluating any microcap, especially one with a potential squeeze thesis, we always check for dilution risk. Dilution occurs when a company issues new shares, increasing the total share count and, in turn, potentially lowering the value of existing shares. This can effectively negate any short squeeze, as new shares provide an easier path for short sellers to cover their positions or reduce the impact of rising demand. For BOXL, we found no recent dilutive SEC filings, such as -1s, -3s, or 424B filings, in the last 90 days, which is a positive sign for the squeeze thesis. Recent reverse split watch. Another important factor for BOXL is its recent reverse stock split. On June 22, 2026, which was 58 days ago, BOXL executed a 1-for-6 reverse stock split. A reverse split reduces the number of outstanding shares and, proportionally, increases the share price. This also shrinks the float, making it even tighter. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market digests the new share structure. While BOXL is now 58 days post-split, putting it outside that immediate 1-month window, the reduced float combined with a hard-to-borrow situation could still contribute to potential volatility. Remember, this is a pattern observed in some microcaps, not a guarantee. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given BOXL's unique profile, what should traders keep an eye on? First, continue monitoring the cost to borrow and any potential updates on shares available to borrow. If the supply dwindles further, it could amplify the situation. Second, watch for any significant increase in volume, especially on green days, which could signal buying pressure. Today's volume of 229,000 shares is significantly below average. A spike in volume accompanied by positive price action would be a key indicator. Lastly, remember that BOXL's incredibly small estimated float of 0.5 million shares makes it particularly susceptible to rapid price movements if buying pressure emerges. BOXL Corporation, BOXL, presents a fascinating case study in the world of hard-to-borrow stocks. With its staggering 944.0% cost to borrow, tiny float, and recent reverse split, it certainly fits the profile of a name that warrants close observation for educational purposes. But as always, never forget the risks involved with highly volatile microcap stocks. Do your own thorough due diligence. If you found this breakdown helpful, please hit that like button, subscribe for more deep dives into unique market opportunities, and let us know your thoughts or any questions in the comments below.